So, I think what's happening, Paul, is investors can't really figure out when the end of the ceasefire, when the end of the conflict is going to be in the Middle East. And in the meantime, they're focusing on what they can control, what they can observe, and that is artificial intelligence.
Yep.
And I will say the total addressable market for AI just keeps on expanding. This year, with the move from conversational AI to agentic AI to glimpses of physical AI. And what do you need for all of that is semiconductors.
Yep.
And so that's why investors keep flocking to the space.
So as we step back, I mean, it looks like, I don't know, we're all in the same boat trying to figure out what's going to happen in Iran. But I think what we can, at least in the near term, it's higher for longer energy costs.
Yeah.
And we're starting to see like a number of companies call that out, most notably the airlines. And maybe they've been calling out and really calling out the cost, incremental cost for energy. How does that factor into kind of your outlook for these markets if we do have a higher energy sector for longer?
That's right. I mean, I think the really critical distinction for the market is how high and for how long. I think if oil is at $120 dollars a barrel for a long time, then this is going to drive material cost inflation. But we're talking about oil being at $80 or $90 a barrel, which is sort of the new normal. I think that's more than manageable for companies. And I would say we're in that latter camp, which is, look, the conflict will eventually be resolved and the Strait of Hormuz most likely will be opened up. But what we'll end up with are inventory levels that are sufficiently depleted, so that does require a higher cost of a barrel. But again, $80 or $90. Now, at Partners Group, we have been thinking about what this means for a variety of our portfolio companies. And I will say, very few of our portfolio companies, 8 out of 65, have some sort of commodity or oil exposure. But even that exposure, it's minimal, and it can be mitigated with cost pass-throughs and contractual obligations.
You have 65 companies?
In our private equity direct portfolio.
That's a hell of a conference call.
Yes, exactly.
When you're on linked up with 65, it's like the lights dim in Zurich when she does that.
So, Anastasia, let's talk about earnings here. We're kind of got right smack in the middle of earnings season right here. Earnings have been really good again, and I've seen analysts take their estimates up, which seems kind of strange in an environment where there's so much uncertainty. How do you think about the earnings picture out there?
I think it's been stellar. I think it's been a rock star earnings season. I mean, really.
I've never seen it. It's nuts.
I mean, no matter where you look at, Tom, 88% of the companies are beating expectations. The surprise is 10%. And, we used to slice and dice it and say, well, Max 7 are doing great, the rest are not. Now everybody's actually delivering 10% plus earnings growth. And NVIDIA is a standout there. So I think it's a really robust earnings season. And it really goes back to the point that companies can withstand oil inflation because they pass that through. And also they have hedges in place. So at the moment, it's back to economic strength.
Okay.
That's the message.
We're doing psycho. It's like Dr. Tom. Folks, it's Bloomberg Surveillance with Dr. Tom. When you were sitting in a classroom absolutely killing it at the University of New Mexico,
Lobos.
what was the optimism then that you had that you clearly have now as you've led in this bull market? I want you to talk to the gloom crew and to explain the Amoroso visceral optimism that was in the third row in a finance class. I don't even know where the University of New Mexico. It's next to Arizona, right?
It is, and it was always the first row. It was always.
I can't imagine.
It was always the first row, but look. I mean, if we think about the basics of the U.S. economy, the U.S. or global stock market, it's about the earnings growth. It's about the multiple and what drives that earnings growth. And what I'm excited about today is that you have multiple engines of growth playing out in the economy. Maybe that's what's really different, is this is now a multi-engine economy, unlike we've had for quite some time. You've got the consumer side that is really doing well despite the higher gasoline prices. You've got the corporate side, Tom, that we just talked about, but also we've got the U.S. economy that's 63% less oil intensive than it was. So that's why it's able to shake it off. And then we have the AI CapEx story, which, by the way, AI CapEx investing has driven 35 to 45% of economic growth over the last couple of quarters or several quarters. And I don't see that stopping. So you have a lot of engines that are working. And so how can you be, overly pessimistic against that environment?
What is the AI story from your perspective these days? Because initially in the first year or two, it was just whoever's investing in it, that's who we're going to go, and whether it's the chip names or whatever. Now it seems like the market's trying to differentiate between some winners and losers, and they threw out some software companies earlier in the year, the SaaS companies. How do you guys think about it now?
Yeah, so clearly we've been thinking about AI for a number of years. We have a dedicated effort to infuse AI into our portfolio companies. In the market, something like 35% of CEOs or companies are embedding AI, are adopting AI. For us, 90% of our portfolio companies have an AI initiative. So having said that, we've been thinking about it for a while, and you're exactly right. It is a bifurcation story. Some companies will absolutely be disrupted by AI. So when we sit in our global investment committee, that's always the question: will this company be helped or hurt by artificial intelligence? Now, pivoting to software, though, I think the market threw everything out with the bathwater and said software is dead and is dead now. That is not the case. That is not our view. I think some software companies will be disproportionately more impacted than others. But if you think about software, what does software have? Is profit margin. Gross profit margin for software companies is 75%. So do you think these companies around the world are sitting there and waiting for agentic AI to come for them and do nothing about it? Or are they investing and adapting?
I just did this study. This is Bob Cinch years ago at Bear Stearns and Bank of America. Are you ready? I did a Fibonacci retracement from the peak of Microsoft in August of last year, I guess, down to the bottom here, which is the gloom of March of this year. In Anastasia, it's perfectly done a Fibonacci retracement to 38% up from the bottom. I mean, it's not even halfway back to the peak enthusiasm. Is that sector still cheap, as identified by Microsoft, which, it's come back, but it's not even halfway back?
I think the sector is also seeing divergence and dispersion, and I think you have to parse through the hyperscalers. The areas that I think are doing well is the cloud business, whether it's Microsoft, whether it's Google, whether it's Amazon. That's projected to accelerate 23% or more this year and further into next year. So that's the part of the business I think we can like. The big question for the likes of Microsoft is the software. And I was just sitting in a break room with your upcoming guest where we're talking about the use of Claude and the use of Grok and the use of other tools, and how some of those applications are great for charts. Some of those applications are great for formatting and fetching data. So what does that do to the traditional, database and software type applications?
Okay, so what's it do to Excel?
Well, it supplants it. It makes you,
or it brings up the VBA for dummies like me, so you can dump it right in, right?
It allows you to skip ahead.
Were you completely fluent in VBA at 15, or were you fluent at 17?
I was not, but you know what? My team now is very fluent in VBA.
Oh, your team, exactly. We don't have a team, so whatever, Claude, Perplexity, whatever, that's the team, right?
That is the extended team, for sure.
And that helps you do Excel, right, to close the loop?
It helps you do Excel. It helps you fetch the data in a much more timely manner. It helps you come up with the charts much quicker than you might have done otherwise.
Okay, but you're still going to use Excel.
It's not a replacement. It is an extension, I would say.
So when you were at Duke, was like the entire class all VBA, and you were like, what in God's
Exactly.
name? I looked at VBA, my eyes glazed over.
Yeah, I was not that. I was the guy who just got up and gave the presentation.
I picked up a can of Coors 3-2 beer and said, okay, let's do this.
That probably didn't help.
Anastasia, what screens well for you guys today? I don't know if it's an industry, a sector, a factor. What's attractive to you guys these days?
Yeah, we are thematic investors, so we're constantly thinking of themes that are here to stay for the next several years. And, what really does jump out today is this theme of energy efficiency, energy independence, energy diversification. And again, as we think about the higher price of oil, some of our portfolio companies stand to benefit from that because they're in the energy infrastructure business. Longer term, also some of our portfolio companies that are likely to benefit maybe provide energy efficiency. What if we are in a higher for longer energy cost? You need to really focus on that. We focus on energy diversification. Maybe it's bio LNG versus regular LNG. And we also focus on the resiliency and the security of the energy infrastructure. And if you think about some of the pipeline businesses, especially in the US, Mexico, North America, those are really well positioned, not only near term to capture the upside in volumes, but longer term, because clearly security of energy supply is paramount to everything we're talking about, including AI.
So it's interesting here. I mean, are you concerned about valuation in this market? Because we had, that sell-off earlier in the year, and people were even making the call, boy, the market is cheaper. It's not cheap, but it's cheaper. But now we've ripped right back up again. Is valuation a concern for you guys?
Yeah. Look, I'm not overly concerned about public market valuations. I'll tell you why. But I also want to highlight the fact that private equity is actually trading or pricing at a 15-year low in valuations relative to public markets. So just to extend both of those points, if you think about public market valuations, if you look at Max 7, what's happened there is in the last year or two, it's not actually multiple expansion, but it has been earnings growth. So for that reason, I'm not overly worried about the level of valuations there. If you look at the rest of the S&P 500 or MSCI all country world, you have seen quite a lot of multiple expansion. But the reason I'm not concerned about that is because you do have economic growth that is doing well, and you do have the earnings growth that's accelerating as well. So I think we can grow into those valuations. But again, back to my point on private equity, private equity multiples are at about 12 times or so EV to EBITDA versus about 15 or 16, which is the public market comp. That means you're at the lowest level. You have the largest valuation discount on private equity in about 15 years. So I think the complement of the two can be really attractive for investors.